Tips on savings strategies for 2024. By following these tips, you can maximize your savings and improve your overall financial health in 2024. Consistency, planning, and smart financial habits are key to building long-term wealth. 1. Automate your savings. Why? Automating your savings ensures consistency and removes the temptation to spend money before saving. How? Set up automatic transfers from your checking account to a dedicated savings or investment account. Many banks offer tools to schedule automatic transfers. 2. Increase savings with pay raises. Why? When you get a pay raise or bonus, it's easy to increase spending, known as lifestyle inflation. Instead, use this extra income to boost savings. How? Allocate at least 50% of any pay raise or bonus directly into your savings or investment accounts. 3. Take advantage of high-yield savings accounts. Why? Interest rates are projected to stay relatively high in 2024, so you can earn more on your savings. How? Open a high-yield savings account, which typically offers interest rates higher than traditional savings accounts. Compare rates regularly to ensure you're getting the best deal. Why? You might be surprised how much you spend on non-essential items like subscriptions, dining out, or impulse purchases. How? Use budgeting apps like Mint or YNAB to track your spending. Analyze your monthly expenses and cut unnecessary or underused subscriptions or services. 5. Create an emergency fund. Why? An emergency fund acts as a financial cushion in case of unexpected events like medical expenses or job loss. How? Aim to save at least 6 months of living expenses in an easily accessible account, such as a high-yield savings account. 6. Take advantage of tax-advantaged accounts. Why? Tax-advantaged accounts like 401ks or IRAs can help you save for retirement while reducing your taxable income. How? Contribute the maximum allowed to your employer-sponsored 401k or open an individual retirement account, IRA. If available, take full advantage of employer matching contributions. 7. Focus on debt repayment. Why? High-interest debt, like credit card debt, can significantly eat into your savings. How? Use the debt snowball, pay smallest debts first, or debt avalanche, focus on highest interest debt, methods to aggressively pay down debt while contributing to savings. 8. Use windfalls wisely. Why? Unexpected windfalls, like tax refunds or bonuses, can significantly increase your savings. How? Avoid the temptation to splurge on discretionary items. Instead, allocate a portion of any windfall to your emergency fund, retirement account, or high-interest debt repayment. 9. Invest in low-cost index funds. Why? Long-term savings are best grown through investments, and index funds provide a low-cost, diversified way to invest in the stock market. How? Set up a monthly investment in low-cost index funds or ETFs that track major market indices. Over time, these investments are expected to yield higher returns than traditional savings accounts. 10. Save for specific goals. Why? Specific goals help motivate savings and create a clear vision for your financial future. How? Create separate savings buckets for different goals, such as vacations, home purchases, or education funds. Use tools like Alibank's Savings Buckets feature to keep your savings organized and goal-oriented. 11. Adjust your budget for inflation. Why? Prices for goods and services are expected to remain elevated in 2024 due to inflation, impacting your spending power. How? Review your budget regularly and adjust it to account for rising costs in essential categories like groceries, utilities, and transportation. Identify areas where you can cut back to offset higher prices. 12. Leverage cashback and rewards. Why? Many financial products, such as credit cards and apps, offer cashback or rewards on purchases. How? Use cashback credit cards responsibly, paying off the full balance each month to avoid interest charges. You can also use rewards apps like Rakuten or Honey to earn rebates on everyday purchases. 13. Monitor interest rates on debts. Why? Interest rates may remain high, which could increase the cost of borrowing for loans and credit cards. How? If you have high interest debt, consider refinancing or consolidating to lower rates. Compare personal loan rates or use balance transfer cards with lower introductory rates to reduce interest payments. 14. Reevaluate insurance policies. Why? Insurance costs, especially health, auto, and home insurance, are rising. How? Shop around for better insurance rates or bundle policies to save money. You can also increase deductibles to lower monthly premiums, as long as you have an emergency fund in place to cover higher out-of-pocket costs. 15. Commit to continuous learning. Why? Financial literacy is key to making better money decisions and growing your savings over time. How? Continuously educate yourself on personal finance by reading books, listening to podcasts, and following trusted financial experts. Understanding topics like taxes, investments, and interest rates can help you make smarter financial choices. End.